Hi, welcome to Equisys Financial Services. And we always appreciate your interest in learning stock trading and analysis. And in next few minutes, we're going to study something about DOW Theory. This is interesting concept, and this is the first ever concept has come up to identify demand and supply. And this probably needs some basic knowledge about the analysis and about markets. And you need to really understand some basic terms which we're going to use here. So if you're completely new to market, if you're the first video in this series you're watching is this one, then we strongly recommend you people to see the basic videos, which we about at least 4-5 videos about the basics is already done with. Then after seeing those videos, it's time to get back to the DOW theory. Okay, now we move towards, okay, we always recommend people to trade with knowledge and discipline simply because we understand, we believe that the people who trade with knowledge and discipline are actually making money in markets. Okay, DOW theory. The one who invented this is Charles H. Dow. It's 19th century guy. He's the one who was actually observing market rather than the company. A lot of people forecast stock price by studying company in detail. They make a lot of efforts to study things of the company. They study the company balance sheets, everything. Rather, he was actually started looking at the price movement of the stock. The stock price are going up because a lot of people are buying. The stock price are coming down because a lot of people are selling it. The people buy and sell only if they find some value in the company. So if anyone find a value in a company, naturally he wanted to buy the stock which will reflect as a demand in the company. So he started studying demand and supply, because reaching demand and supply is through price and volume, which is transparent to everybody. So he identified that the concept of the demand and supply, and he has given us a few lines to recognize it. So the concept behind the demand and supply is his observation, but his conclusion is very simple. Open the price charts, spot the tops and bottom. Then qualify the spotted tops and bottom as higher and lower. Okay, you have to name the tops and bottom. Then the next job is very simple. Identify the sequence, like higher top, higher bottom. So start communicating the sequence and identify the volume significance, and you can identify. So we can see things in detail in the next slides here. Okay, what's my first job? Open the charts, use daily charts. Minimum 2 years is required. Okay, it means what? I have to open the charts, assume this chart is the daily charts, and I'm getting the volume in the bottom. I hope you people are actually watching the bottom here, where you get a lot of volumes happening. Our next job is to spot the tops and bottom. Top, bottom, top, bottom, top, bottoms, and tops and bottom here. But interestingly, you can find I'm skipping some tops and bottom in between, because I am actually interested in major tops and bottom. The top is nothing but a selling zone, because a lot of people, as a seller, they become aggressive. See, the prices are actually moving right from bottom and started moving to this extent. There is no much of sellers, there are no much of sellers, there are no much of sellers. But at top it finds significant sellers and it went down. So top is nothing but a supply zone, bottom is nothing but a demand zone, because the bottom is made by the buyers and top is made by the sellers. Because sellers become aggressive, sellers are happy with this price, and the sellers becomes ready to sell the stock at this price, then it become a top. After identifying tops and bottom, he wants us to qualify them. It means this is higher bottom, then this is actually higher bottom, because this bottom is higher compared to the previous. This is a lower bottom because this is lower than the previous. Again, this is a lower bottom is because this bottom is lower than the previous bottom. And this is a higher bottom is because this bottom is higher to the previous bottom. Say this top is a higher top because it is higher than the previous tops. Likewise, I'm just, okay, this is the series of lower tops is because these are the lower than the previous tops. Again, this is a lower tops. The moment you name it, now you have to identify the sequence, which is higher bottom, higher top is the sequence for a bullish. And if it is happening through a good volume, it is a sign of bull. So there is a sequence of higher bottom and higher top. This is a bullish trend as per the DOW theory. And look at this higher top and lower bottom. This is not the sequence expected, because this trend does not signifies anything for the bearish movement. This trend does not signifies anything to qualify the bearish movement. And as far as the higher bottom lower top, it is not a sequence. Lower top lower bottom is a sequence for the bearish. Probably this price movement, the lower top and lower bottom, gives some idea like the prices are actually in the bearish trend. So as per Dow theory, this is a bearish trend, this is a bullish trend. But he always says confirm with the volume. It means while going out of the range, it has to increase the volume. This is a good volume when compared to the recent day. The volume is nothing but the strength, which always signifies the price movements. So probably this is a way to create long position. I hope you people know what is long position. When I buy the stock with the expectation the price to go up and I plan to sell it sometime later, it's a long position. I'm creating a short position. It's not, I don't have even a stock, but still I can sell the stock because it is creating lower tops and lower bottom with good volume. So the trend is actually bearish. Okay, as per Dow theory, he always says follow the trend. Never ever go against the trend, because identify the sequence. If the trend is actually positive, then go for the trend. Never aim for selling the stock at the top and buying the stock at the bottom. It means we are following trend, we are not actually forecasting. Someone has to buy and he has to tell some demand is happening, then only we will recognize the demand. So it means we can never be the buying the stock at the bottom. In order to identify the supply, someone has to sell it in the market. It means we cannot identify the top. The moment we witness some weakness, then only we actually sell. It means don't try something which is possible by you and me, because we follow a technical analysis which are not capable of identifying tops and bottom. And bullish is a word you can use only if you find demand is greater than supply. And bearish is a word which you have to use when the supply is greater than demand. And Dow theory is good for deriving trend. So as a traders, we are not going to use Dow theory to buy and sell stock, because it's pretty old, we understand, but it's a good concept to learn demand and supply. So it is good to identify the trend. If anyone is asking me about trend, in short, I can look at the Dow theory, I can say it is positive and negative. But this trend is valid for a medium term, about a monthly basis to 2 months to 3 months. It is not specific to a daily basis or intraday basis. So what next? So the overall Dow theory gives you some basic aspect of the market trend. But if you really wanted to trade, you have to understand the price behavior, which you can actually get it from the price patterns of double tops and double bottom. And probably check out the next videos which you can actually find it. If you find this video useful, if you find something about Dow, if you understand the sequence, probably we request you people to share it in your portal, any of your social network, Facebook. It would probably take a few minutes, but it can a lot help us. If you have any viewpoints which you wanted to add it in your below comment box, feel free to add your views below. So thanks, happy trading.